October 15th started out as a normal day for the U.S. Treasury market, but take a look at the intraday chart. Yields on the 10-year plunged to 1.86% before rebounding with a 27 basis point jump. It was the largest fluctuation in a quarter century. Did you hear that? Quarter century. Lisa Abramowicz has been digging into this story. This is extraordinary volatility. It blew the doors off half the hedge fund community. Is this the new normal?
People are saying that you can kind of expect going forward that there are going to be these surges in volatility. I mean, to sort of paint the scene, we're coming off of a really low volatility period, right? Record low volatility for a number of years, basically because of the stimulus. So all of a sudden to see a sudden surge, it was the biggest surge in volatility since 1989.
What explains it?
So there are a number of different things. First, you have just the overwhelming positioning of traders shorting rates and treasuries. People have been expecting yields to rise. They've been holding onto those bets, clinging to the expectation that rates would rise. They haven't. They've fallen. This was, to some degree,
so there was
a mass capitulation.
Massive short covering
exactly.
going on.
And you've got to remember the sort of world of derivatives around treasuries has swelled. The options, the futures. So the sort of the $12.4 trillion world of cash treasuries is magnified dramatically by all of the options and futures out there as well. And then on the flip side, you also have a complete change in the structure of Wall Street. You have dealers that previously were using their money to make markets and that previously were paying traders to take risk and to be available.
And now all they can do is act as agent.
Well, is that happening, though, in the Treasury market? Because Treasuries get the biggest discount possible in capital treatment under Basel III. There is no penalty, really, for trading Treasuries the way there is for corporate bonds, the way there is for investing in private equity.
At banks right now, you still can't have a desk taking on billions of risk and sitting on it. You have to prove that you are flushing that, too. It has to be for client business.
Well, and not just that, but you've got to think about why dealers traded Treasuries in the past. The reason why was to sort of offset some of the risk in their books, in their inventories, right, to offset some of the risk in their corporate debt holdings and their other riskier debt holdings. So, some of the activities that they did on the prop side, on the proprietary trading side, and on making markets actually did lead to their holding treasuries to offset those positions. So there is actually more to it than just the risk weighting of treasuries.
There's still market making going on, though, in the Treasury business, to a degree that doesn't exist in some other forms, in some forms of credit, though.
Yes, to some degree, but why would dealers take on risk in treasuries?
They're not allowed to anymore.
And really,
no. I'm not saying that Dodd-Frank is blocking it. The people who are running investment banks right now are not allowing their teams to take on big positions. It's not a regulatory issue. It's a management with inside banks issue at this point.
Well, and there's another dynamic in the room as well, which is electronic trading. You had a surge in the amount of government bonds that have been traded on electronic marketplaces. Tab Group estimates that 60% of U.S. government bond trading will be conducted in electronic systems next year. And they expect that 20% of that will be done by high-frequency traders. So there is a dynamic going on where if there is one mass movement in one direction, why are you going to stand under that falling knife when it's not coming from a rational, that's a loaded word, but it's not coming from a person who's thinking in real time and who's able to think in real time because the market's moving so quickly.
Now, when we talk about electronic trading in this context, it's not exactly the same as what people have gotten used to in the equity world. The so-called flash boys that Michael Lewis wrote about in his book and which have been under much debate since then are different players, I presume, than those who are transacting in the fixed income market.
To some degree, but there are high-frequency traders that are using algorithms to determine when to buy or sell. So there is some speculation that on October 15th, there was a lot of bad news coming out. There were headlines about Ebola.
Yeah, but there's always been
Russia.
black box algo trading in the fixed income markets. But that's not new.
But it's a growing proportion of the market. There are fewer dealers and traders on the other side willing to take the other side. And you've got to think about the positioning in the market. The huge short position on treasuries, it's not just people who are just flat outright speculating on treasuries. It's people who are holding high yield bonds, loans, illiquid securities. They're trying to hedge against a potential rate rise to offset that risk in their fixed income portfolios. So there is a lot of hedging going on. The world of derivatives tied to treasuries has swelled, really. So it's really pushing people through a narrow door when they do feel like they need to.
Remember when derivatives and options were created to make the market more stable? Things have changed. Lisa, thank you so much.